गया शायद. हाँ, स्टार्ट. Good morning, friends. Welcome to the marathon for Adda 24/7 for CIB. See, today's marathon is the most important marathon today because tomorrow is your exam, and today we'll be covering all the important case studies of Module B as well as if Module A possible. But Module B will be surely covering it because Module B is a major event and major part of your BFM paper. Okay, so go for it as far. Watch this marathon till the end. Okay, before going, I would suggest say this: we are coming up with this new batch of December 2022 exam. Remember one important part in December this exam. In December exam, remember one important part. Here, one sec. Yeah. In this exam, this is the last exam with this portion. In May 2023, the portion would be different. So, hello. अच्छा. हम्म. बोलो. चलेगा. एक मिनट. हाँ, एक मिनट मुझे ज़रा इसको वापस लेने दो. स्टार्ट. गुड मॉर्निंग फ्रेंड्स. वेलकम टू अड्डा 24/7. Today's session, today's marathon is on Module B majorly. All the important case studies of Module B. Remember, Module B covers on an average 60 to 70 marks in the BFM paper. So, yeah, it covers majorly 60 marks, 50 to 60 marks in your BFM paper. So, the case studies are very important for this. Remember, yeah. Voice is slow. Many of them are complaining voice is slow. Is my voice slow? Type yes in the comment section. If it's okay, type okay. Then we'll go ahead. Good morning everyone. Hi, morning everyone. So just one day remaining. I would suggest if you want to really clear BFM paper, I would suggest if possible take a leave today from the banking. If you don't have holiday, take a leave from the banking fraternity today. Okay, because the BFM is the most toughest topic in entire CIB. I would suggest. Okay, so if possible, take the leave. If not, then try to study as much as possible, and today skip some. Do only important part in your job profile today. Okay. So before going ahead with the marathon, I would suggest see this. We are coming up with this batch for December 2022 exam. Remember one important part. December 2022 is the last exam with this portion. In May 2023, the portion will be changing. It will be a new portion. So try to study. Try to complete your CIB in December exam itself. Okay, I'll come more on this later. So let's start with the today's topic. Okay, what did I say? In today's marathon we'll be covering Module B case studies. This is very important. Module A if possible, if time permits, because what happens, Module B is very important as such. Means roughly I've seen almost half of the paper, and the point with Module B is if you understand Module B, then Module C and D are similar. They are dependent on Module B. Okay, so you need to understand Module B first. Okay, that's why I have taken this topic today, because many of the Module A is covered by many in other marathons also. So let's start with the topic. Here, first problem is the daily volatility of a security is 2%. How much will be the monthly volatility? Now, how to cover this daily and monthly business? Say this. Keep the rule very simple. The rule is very simple for daily and monthly volatility. See here, let they ask you daily, monthly volatility, or let they ask you yearly volatility, see here, per annum, or let they ask you weekly volatility, anything let they ask you. Always your prime target is to find daily volatility. Okay, first target is to find daily volatility. Okay, yeah. So now I'll tell you now how to find the daily volatility. See here, if it is given in the problem, then it's okay. See here, it's already given. The daily volatility of the security is 2%. If it is given, then it's the easiest part, nothing more than that. So how to find the monthly volatility if daily is given? See here, monthly equals to, rule is very simple. Monthly equals to daily into square root of number of days. Now what is this number of days? See this n. This n will be 30 for month. I'll write it over here. 7 for weekly if it is asked, then 7. Okay, and for year if it is asked. See here, in the year, what is the point? They sometimes give you, say this in the second problem. If there are 250 working days, see here, trading days per annum is 250. If they give you 250, then it's okay. Means if they give you any year, if they give you 200, then take that year. If they don't give you, then take your general 365 for the year. 365 for the year. Okay. So always remember in exam, never jump to get the 365 days. Check what have they given in the year. Okay. If they have given 250, take square root of 250. If they have given 30, take a month, take square root of 30. Okay. Got this point, everyone? Type yes if you have understood this up till now. Not given, take 25 days. Yeah. See here, if it is given, understand this again. If it is given for month, any days they might have given. They might have given 25 days. Then take whatever is given. Okay. See here, some guys are asking, okay, what should we take for month? Some are asking, what should we take for week? See here, whenever they give something, take that only. If they don't give, then take the general number of days which we have. For month we have 30 days, for week we have 7 days, for year we have 365 days. Okay. Now use the calcium, that's simple now. Okay. So daily volatility into square root of 30. We want it monthly now, the square root of 30. So 2 into square root of 30 is what? 5.477. Okay. Take the calci and pen and paper in your hand, because you solve it over here and you'll see now the problems are easier, but now the problem level will get difficult now. Okay. So use pen and paper and try to solve it yourself. Okay. So 2 into 5.477, 10.95. So this is your answer. This answer will be given to you and 1 mark is in your pocket. Next, if per annum volatility is 30, one second, yeah. If per annum volatility is 30 over here, 30%, number of trading days per annum is 250, how much will be the daily volatility? See here, now the question asked is the reverse one. Monthly is given, monthly means yearly is given over here, and daily is asked. So annual volatility equals to what? Daily into square root of the days are given, 250. So I'll write it over here, y equals to d into square root of 250, right? So y I know 30. 30 equals to d into square root of 250 is what? 15.81. Okay, we have the calci, try it on your calci. Never apply your brains in calculations, okay? Because we are bankers, I know how we do the calculations in banking, because I have myself been in the banking for more than 13 years, and that also foreign banks, okay? So I know, never apply your brain for while doing calculations. Apply your black calci which we have, and in exam also take the general calci only. Okay, so take the general calci. See here, important part is general calci. Why am I telling you? Because scientific calcis are not allowed in the exam. Okay, so move on. So d equals to 30 upon 15.81. It becomes 1.90%. Okay, got this point? See here. So now generally they'll be giving you that within this month, how many days are the working days, or week, how many days are the working days. That's what they give you generally. Okay. But if not given as per your BFM book, BFM book takes you, means Macmillan book takes 7 days a week, 30 days a month, and 365 days a year. Okay. If, see here, what I would suggest, one more point. See here, how much time does it take to take a square root of 7, or if you want, take a square root of 5? If the answers are here, the paper setters are different. So what you can do, if you have some doubt, take once the square root of 7 and then try the answer whatever is there in the question, and then next take the square root of 5 and then try the answer. Some answer will be definitely there, because here what happens is, it depends on the paper setter. If the paper setter thinks that there are 5 days a week, he'll apply the logic of 5 days. If the paper setter thinks there are 25 days a week in a month, okay, he'll apply the logic of 25 days. So we hardly have to take only square root. So try the square root for both the days, 30 days also and 7 days also. For week 7 days, for week 5 days, for a month 22 days are also there. See here, generally in treasury is working for this 5 days a week. So 2 days a holiday. 2 into 4, 8. So 30 minus 8 is what? 22. So some banks, some books do take 22 also. So now it's a difficult part for you, whether to take 22 or 25 or 30. Okay. Your Macmillan book takes month as 30. Your Macmillan book takes week as 7. But again I am telling you, if your Macmillan book takes year as 365. Okay. But again I am telling you, it hardly takes 2 seconds to get a square root of 30. So why to risk 1 mark for that? If your answer fits with these numbers 37, 365, use these. If your answer doesn't fit and the answer is something different, then what you do? Then go for 5 or 7. See here, the options won't be the same. Remember, if both options are given, both options will not be given. Okay, definitely they are not given. Okay. And remember, again I am telling you, Macmillan book takes month as 30, week as 7, and year as 365. Okay. So these are the actual figures, but again the paper setter, it depends on the paper setter. Let's move on. Let's not waste our time on in these days. You hardly can have 2 seconds more to try all the options over there. And again I am telling you, both the options will not be given. 7 days and 5 days it won't be given. Okay. 1 day VAR of the portfolio is rupees 50,000 with 97% confidence. In a year, in a period of 1 year of 300 trading days, how many times the loss on the portfolio may exceed 50,000? Mind it from me, this question in some form or the other will definitely come to you in exam. Take it from me, because this question is the most important question, one liner, 1 mark question. Okay, it's the most important. Why? Because this question covers 2-3 parts. Which parts does it cover? First, it covers value at risk. So you need to understand what do you mean by value at risk. Then it covers confidence level, 97% confidence. You mean to understand, it means that you need to understand what do you mean by confidence level. Okay. So, and then trading days are given. So this part is simpler. Okay. Now the question is, how many times the loss on the portfolio may exceed 50,000? It has to exceed 50,000. See here, understand the logic behind this problem. See here, the point is, the value of the portfolio is 50,000. Means VR of the portfolio is 50,000. Means what? I am taking into risk that 50,000 will be my value at risk. 50,000 amount of mine is at risk. Okay. Means I am a banker and I am taking into account that 50,000 of my amount will definitely be at risk. So that is accepted by me. Okay. So this is not a problem now. Now the problem is, if the amount moves, my risk goes more than 50,000, then that's a problem. So if my risk goes more than 50,000, that's what I have to calculate. So what is the question given? See this, 97% confidence. What do you mean by 97% confidence here? Out of 100 days, see here, what does percentage mean? Percentage is always for 100. Okay. So out of 100 days, in 97 days, my risk is less than or equal to 50,000. Okay. So what does it mean? For 3 days out of 100, 3 days my risk will be greater than 50,000. Now this is the problem for me. This is not a problem. This is okay. And this is the problem. Now I have to focus only on this problem. Okay. So how to do it? See this. For 100 it is 3 days. Now what is given in 300 trading days? 300 trading days. So 100 it is 3. So 300 it is 300 equals to what? 9 into 3, right? So that's how we do it. Are you getting this? Are you able to see the screen? What am I writing? Are you able to see the screen whichever I am writing now, guys? Type yes if you are okay. Are you able to write? Because I am writing something on this screen. Are you able to see this? How to solve this? Hi, yes. Type yes. Okay, are you able to hear me? Hi guys. Yeah. Shall we move on with the next? Is it okay? Have you understood this problem? See here, confidence level always give you the level at which your value is within the control, and above that means whenever you write this, above that, whenever it's out of control, that's what is a concern for you always in any treasury department. Okay, so out of 100, if we are having the problem with 3 days, we'll be focusing for the 1 year, and 1 year it's 300. 300 means what? Out of 100, 3, so 300 it is 9, right? Let's move on. Okay, now I told you I'll be covering case studies only, but this theory part is very important for you from case study point of view also, and 1 mark 1 liners point of view also. Understand this case study very clearly and thoroughly. See here, throughout your banking career, if you work in treasury department, if you work in trade finance department, further in future in your life, okay, so that in that you will definitely get these problems. Okay, somebody is asking me, can you show another example like this, sir? Okay, definitely, why not? See this, the confidence level given over here is 97%. I'll take the confidence level, let's say 90%. Okay, let's say one more example. See, same problem, 50,000 risk and 90% confidence. So what does it mean? See here, we are doing it with 90% now, 90% confidence. Okay, confidence. Okay, so now if I am doing it with 90% confidence, it means what? See this, out of 100 I am having 90 days, my this risk is within 50,000. so out of 100, 10 days my risk is beyond 50,000, right? So if out of 100 I am having it for 10 days, see here, out of 100 if I am having it for 10 days, then for 300 days how much it will be? 300 into 10. So it is, see here, out of 100, 10 days. So 300 will be 30 days. That will be the answer over here. Okay, so 30 days. Got this point, everyone? See this, out of 100 I am having, let's say confidence level is 90%. So out of 100 I am having for 90% days, means out of 100, 90 days I am having the risk of this 50,000 only. So out of 100 for 10 days my risk will be greater than 50,000. For 90 days it's within the limit, within 50,000. So if for 100 it is 10 days, for 300 days, what is given in the question? 300 days, and confidence level we have changed it. We have changed this 97 to, we have made it 90% now. Okay, so for 100 it is 10, so 300 it is 30. It's that simple. Okay, now this part is very important for you. DC credit, direct credit substitutes. Now what do you mean by credit substitutes? First, this theory part you must understand. What do you mean by credit substitutes? Here, credit substitute means these are all general guarantees, acceptances, everything given. Okay, now what do you mean by credit? The credit substitute means, suppose if this guarantee I give, if I am the bank, let's take an example, I am the bank and you are the customer. Okay, I give a guarantee on your behalf to some XYZ agency. Okay, means you are, let's say, the contractor. Okay, so if I give you a guarantee on your behalf to some XYZ municipality or some government department, then the risk factor of that is 100% on me, because this is a financial guarantee. Remember, understand this important part. There are three parts in this. First is this, second is this, and third is this short-term LC. Okay, there are three parts in this. Okay, general guarantees means what? These are known as financial guarantees. Financial means what? There is no performance involved. Remember this. There is no performance involved. Okay, here there is no performance involved. That's why the risk is 100%. Okay, let's take one example. I'll give you an example for this. Whenever you take a loan, okay, home loan generally, in many of the nationalized banks we still have the concept of guarantor, right? In many of the private banks and others have moved on from guarantor system, so we still have the guarantor. Why do we have the guarantor, and what is the liability of that guarantor? See this. The liability of that guarantor, remember, is 100%. If the customer doesn't pay, then the guarantor has to pay full 100%. Why? Because this is purely financial guarantee. The guarantor for home loan or any loan, for example, not only home loan, any loan, the guarantor gives the full 100% guarantee. So this is known as a financial guarantee. Now I'll give you one more example for this financial guarantee. If you as a bank tell me, suppose you are a bank today, okay, and you tell me that I will pay you some 1 lakh rupees after 3 months if you write it to me without any condition. So what is that? You are taking the 100% guarantee, no conditions involved, okay, no ifs and buts, right? So in that case, what happens? If you are going to pay me immediately whatever amount is given, then the point is you are taking the 100% responsibility. Now the second part, transaction related contingent items means what? Performance bonds, bid bonds, all. Now this is what, this some performance is involved over here. Performance, okay, means what? Performance means here, if I tell you that based on you, suppose you are the customer of mine, let's say I'll type it over here, you are the customer of mine, I am the bank, you are the customer, and this is a government agency, okay. Now based on you, I have to give the guarantee to someone. So what will I tell the government? See this, this person will build a bridge for you. Suppose if you are a contractor, this person will build a bridge for you, and if he does not build the bridge, then I will pay you so and so amount. Okay, that is known as performance guarantee. If this person does not perform, then I will pay you. Now what is involved over here? Here your performance is involved, means the risk is divided between you and me, right? So that's why we take it 50% over here. Always remember this, okay? So point is always the if somebody else is performing, and then your risk gets divided into two, and here in first one nobody is performing, that's why it's 100% risk is on your bank itself, okay. Now third, warranties, indemnities, yeah, all this is 50%. This comes under 50% full. See here, this full, this to this complete is 50%, okay. So this 50% is related to transaction related contingent items, performance bond, bid bonds, warranties, indemnities, standby, LCs related to particular transaction. Remember, in standby there are various types of standby. One is financial standby. What do you mean by standby basically? Standby means guarantees only. There is no other word to standby. Guarantees and standby are same. In US and UK, they don't issue guarantees. Banks are not allowed to issue guarantees actually, because US and UK says guarantee giving the guarantee is not the job of the bank. So what have they done? They have given it a different name, standby LC. Okay, now they can issue it, but the logic is always the same. Standby LC and guarantee same. Means you eat it this way or you eat it that way. It's the same. Okay, so they say you can't issue guarantees, but they say you can issue standby. Then what is the difference? So that's why we Indians are clever. We say guarantee means guarantee, standby means standby. Even in many of our banks, those who are working in trade finance department, they know that they issue standby LCs many times, isn't it? Okay. So no, don't go deep into that. We have to clear CIB. Here, our target is always I say to my students, you don't have to do PhD in BFM. You don't have to do PhD in ABM. Neither retail. What have you to do? You have to get at least 50 marks in ABM, BFM, retail and clear that exam. Everything is 1 mark for you, nothing more than that, right? Moh Maya, everything is over. Studies, knowledge, everything is out. Everything is 1 mark for you, 1 mark, because that 1 mark counts. Understand the difference between 49 and 50. Many of you might be knowing, right? 49 and 50. What is the difference? It's the difference of at least 6 months. 49 and 50, the difference is at least 6 months. 6 months into 1 increment, right? Means CIB means 2 increment. 1300 into 6, right? 36, right? Roughly 1300 is your average increment, right? 13 6 is 78. 7800 is the difference between 49 and 50, right? At least, if you can clear within 1 year, then it's okay. Within 6 months, it's okay. And this December exam, once it is over, then the next May 23 exam will be with the new portion. It won't be with this old portion. So remember this, the difference between 49 and 50 over year in this time will be used not for 6 months. It may be used, okay? Because new portion you don't know. What is the depth of that portion, okay? Move on. So short-term LC document. So this short-term LC for issuing as well as confirming bank it is 20%. Now what is short-term LC? Remember, LC is of two types. Always remember this. LC is of two types. One is documentary LC and second is clean LC. Okay. So documentary and clean. I'll write this over here. Okay, so that you understand it better. One sec. Yeah. See this. LC is of two types always, documentary and clean. And remember, these two terms may come in the exam. Documentary LC, doc LC, I'll write it, okay? And clean LC, okay? Okay. So which are the what do you mean? What is the difference between documentary LC and clean LC? See this. Documentary, what to take? Sir, in 50% and 100% standby LC is there, what to take? Okay. See here, somebody has asked me this question. If both the things are given, standby is given to 50% also and standby for 100% also, which one to take? Okay, that's the thing which we need to understand. See here, financial guarantee, never go by these words alone. Look at what is given in the history before that, some words before that. See here, if the standby is for a particular transaction, this is 50%. If it's a general standby, financial standby, general standby, these words are used, take it 100%. Got this point, everyone? See here, these names, that's what I said. Even LC, see here, LC, documentary LC and clean LC, both the words may be given to you. Documentary LC risk factor is 20% and clean LC, the risk factor is 100%. 100% for clean LC and documentary LC it's 20%. Then again you'll get confused. Which one should I take? So understand the difference here. That's what I always say. IIBF or CIIB is about understanding. If you understand the topic, it's very easy. If you don't understand the topic, you just mug up like a parrot. It won't help. It won't be helpful for you. Okay. So you have to understand this. Documentary LC means what? There are 6 documents involved in any documentary LC, right? Which are the 6 documents? Can anyone tell me which are the 6 documents now over here? Fast. Which are the 6 documents involved over here? See here, I always tell you 2I, 2B, right, and PC. What is 2I, 2B, PC? 2I means what? Invoice and insurance. Okay. Let me write it over here. Invoice and insurance. I'll write it over here. Okay. Let me see. I'll write it over here. See here. Invoice, insurance. Okay. These are the 2 documents for I. 2B, bill of exchange, BOE. We call it draft also. Other name for BOE is draft. Okay. And BL, bill of lading. Now BL may change. See here. If the shipment, This is all related to trade finance. Okay, if you are sending the goods via ship, then it's BL. If you are sending the goods via air, then it's airway bill. If you are sending the goods via truck, it is a truck receipt. If you are sending the goods via rail, it's a railway receipt, right? So it depends on what goods. I have taken this for simplicity, 2B. So bill of lading. It may change to airway bill also. It may change to this truck receipt also, anything. Basically transport document, okay? And next is what? PC. PC means what? One is packing list. Packing list, okay? Packing list. And last is COO, Certificate of Origin. Remember, this is an important document. These two are important documents, although these are non-negotiable documents. Understand? I'll come to this also. See here, while taking, this is my problem. When I take any topic, I go to depth of this, because I feel that you must understand this topic till the end. Okay, it's not that some doubt should remain in your mind. Okay, so invoice means here, which are the negotiable documents over here? Insurance is a negotiable document, bill of exchange is a negotiable document, and bill of lading is a negotiable document. Okay, remember, only if it is BL, then it's a negotiable document. If it's a airway bill, okay, then it's not a negotiable document. Truck receipt, not negotiable. Railway receipt, not negotiable. Got this point? Okay, now insurance, bill of exchange, and bill of lading, these three are negotiable, remaining are non-negotiable. So wherever we are not into this LC business now. What am I taking is module B, right? So 2I, LC is 20%. Documentary LC. If I am having all these 6 documents in that LC, then the risk is very less, right? When it means that I have covered everything and the transaction is genuine. See here, why do we take this risk factor? 20%, 50%, 100%. Why do we take it? We take it because the level of risk, if the level of risk goes on increasing, will increase the risk, right? If I am having all the 6 documents, it means what? The transaction is genuine. It has happened actually. So if it has happened, I will take the lesser risk. In clean LC, what is clean LC? Out of these 6 documents, nothing is asked in clean LC. Only one document is asked, and that is only B, bill of exchange. I'll write it over here. See this, bill of exchange, BOE, only that is asked. Okay, so that's why clean LC will always be a riskier element. Okay, because the only one document is asked. You don't know whether that transaction has actually happened or not, and you as a banker can't go on that port and check whether that goods are shipped, right? You can't go do that. So you have to deal with documents only. That's why we apply the risk factors to this. Okay, so got this point, everyone? General LCs, general guarantees, or general LCs also, clean LCs, 100%, no performance involved, right? Transaction related or performance related, 50%, and this short term LC with all the documents, it's 20%. Okay, now this is part 1, CCF. Okay, now second part of credit conversion is this. For these limits here, all of these were non-funded. There are 2 types of fundings always in bank. Remember, which are 2 types of loans. Which one? One is non-funded and second is funded, right? Non-funded means what? All this LC guarantee, where we don't part with the funds immediately, but we give a guarantee to someone, we give a commitment to someone. That is known as non-funded. And this is funded. Funded means what? CC, term loan. Here you actually give the money to somebody. Okay, immediately you give it. CC means what? Disbursement. Term loan, disbursement. So this is funded. I'll write it over here. This is this part. I'll write it over here. This is funded. This funded, and this part is non-funded. Okay, non-funded. Okay, got this point? See this. So non-funded and funded, you need to understand. Now what is this for funded? See this, 20%. Now remember one part over here, important part over here in this. Okay, I'll first remove this LC part, because we need some space for this also. Doc, this is clear for you now, everyone? I'll remove this now. Okay, let me remove everything over here so that it becomes easier for me also to write and you also to understand. Okay, now in CC, remember this CC part or term loan part. It's always whenever you give the loan, okay, loan, The loan is of two types, means funded loan, I'll call it funded, okay, means directly cash you give it, okay. In funded loan, what happens? See here, it is of two types. Suppose the loan is, let's say, 100 rupees, okay. This loan is 100 rupees. So there are two possibilities now. This person, whoever that customer is, he'll take full amount disbursement or he'll take part disbursement. Let's say he takes a part disbursement of 40 rupees only. He takes a disbursement, means disbursement done is 40 rupees. This, and 60 is not disbursed. Not disbursed, okay. So now, important part over here is, if 40 is disbursed, means this money is gone to this person. So what is the risk to this? Complete 100%, because why? This money is gone from my pocket, right? This money is gone and this money is still with me. So if this money is with me, I can save it tomorrow. If tomorrow somebody comes and asks me and I find some problem in that person, I can definitely save this money. I won't give this money. So here the risk is lesser and here the risk is more. So anything which is already disbursed, which is taken by that customer, risk factor is 100%. Okay, and this part, now the CCF are for this part now. 60 means what? Which is with me now. It is not taken. Okay, undrawn portion. Okay, so now look at this. 20% of the undrawn CC limits here. Whenever we have a CC limit given to that customer, 100 rupees CC is disbursed, given to that sanctioned, 40 is disbursed, 60 is remaining. So this 60 will have a risk factor of 20%. Okay, in this term loan now, if I sanction the loan, term loan of 100 and 40 is disbursed, so 40 will be taken as a 100% risk. Now about this 60. Now about this 60, remember this, for the term loan which is within a year, the risk factor is 20%. And if it is beyond a year, then the risk factor is 50%. Understand the difference. The risk factor is 50%. Okay. Yeah, Ronnie Deb, he will definitely pass. If someone has got 49 and in the test, a test 2 subjects, he has got 51 and 50, he will definitely clear. Because here, if you are giving all the papers at one time only, then you have that rule of what? Average 50, that is greater than 45 and average should be 50. Only then but, okay. If you are giving it once singly each time, then not possible. If you are giving it all the papers at once only, then this rule of 49, 51, 50 applies. Okay, then he'll clear it. Okay, move on. Chalo, let's move on. Now in this part, term loan, undrawn portion is 50% of the term loan beyond 1 year. Okay, now remember these figures very thoroughly, because now we'll be solving the case studies on this. Calculate the fund-based exposure. See this. What is given now? It's clearly mentioned, fund-based exposure. So fund-based means what? We are dealing with the fund-based. So funds are directly parted. What are the fund-based limits? See this. Cash credit, bill purchased, packing credit and term loan. Okay. Cash credit, bill purchase, packing credit and term loan. Now out of these, remember there are only 2 types of loan in this world. Entire world. You do anything, any banking, anything. There are only 2 types of loans. Okay. One is term loan and the second one is OD or CC, we call it. Term loan and second is CC OD. Okay. Anything falls under this category only. Now let's see. Cash credit, CC comes under CC. Bill purchased. Bill purchase is a OD type of loan. Okay, I'll write it CC OD over here. OD. Okay. Bill purchase is a OD type of loan. Again short term loan. Okay. Remember, these all CCODs are to be renewed in a year. You check anything. You check your gold loan, which you give in the bank. You have to renew it every year. You check your CC. You have to renew it every year. You check your packing credit. You have to renew it after the particular period. It's not for 1 year. Okay. So you check it. OD type of loan or working capital type of loan is to be renewed every year. Okay. So here bill purchase CC. I'll mark it over here. CC. Then bill purchase, and then third one is packing credit. All are OD types of loans, and this term loan is separate. In term loan we have a EMI, and these we don't have a EMI. Okay, let's move on then. So this is what, these are all funded types of limits. Now limit sanctioned. So remember, why did I do this classification? So that you understand it's here. You take anything, cash credit, bill purchase, packing credit. Risk factor will be 20% for these three. Okay, risk factor is 20. I'll write it over here. Risk factor over here is 20%. Okay, always. Now for term loan, we have two parts, 20 and 50. Okay, where 20 and 50, see this, undrawn portion of the term loan, out of undrawn portion of the term loan, 60 is to be drawn in a year. See here, whichever is within the year, we have to take it 20%. Whichever is beyond 1 year, then we have to take it 50, right? Just now we saw it. Got this point? Now let's look at this part. Limit sanctioned. Limit sanctioned is 200 crores, 60 crores, 40 crores and 200 crores for these. Okay. And outstanding. What do you mean by outstanding? Outstanding means drawn. He has already taken this amount. Okay. So if anything is drawn, what did we say about this? The risk factor will be 100% over here. Got this point? Risk factor will be 100%. And this undrawn portion, this is within my control. This I have in my hands. So here I can apply this 20%, 20% and 50% logic. Here I can't apply. Remember this part thoroughly. Whatever is drawn is 100% risk. Never apply this 20, 20, 50 rule in whatever is drawn or outstanding or money is gone. Wherever money is in your hands, you can apply these rules. Okay? Got this point, everyone? Yeah. So let's move on. So now let's solve this query. See this. 100% of the outstanding for CC. See here, whatever is outstanding, what is the total outstanding? 100 plus 30 plus 30 plus 40. So 100 plus 100, total is 200. So complete 200 for the drawn portion, whatever is drawn. Okay. Now what is undrawn? Now look at that. What is undrawn over here? 100, 30, 30. See, this is the OD type of loan. Okay. Now this part, sorry. This is the OD type of loan, right? 100, 30 and 10. This part is undrawn. So this I'll take it within 1 year. Okay. So here it comes out to be 100 plus 30 plus 10, that is 140. So I come to 140 over here. So here I'll take the risk factor of 20%. Okay. 20% is the risk factor. So now my figure comes out to be 140 into 20%. So it is 28. Okay. Now see here, now difficult part is this term loan. Term loan, we have two parts over here, within 1 year and after 1 year. So within 1 year, 20% of the undrawn term loan. So what is the figure given? 60. 60 is given. 60 is to be drawn in a year, right? So 60 into 20%, right? 60 into 20%. So it is 12. Similarly for undrawn portion, 50% for the term loan, that is 100. 100 plus 60 is 160, right? Remember this logic, okay? So 100. So 50% of that is 50, right? Now what is the total of the adjusted exposure? 200 plus 28 plus 12 plus 50. It is 290. Add these and get the answers, okay? Let's move on. So now we have got this answer 290. Now this 290 answer is your final answer, okay? This question will be asked to you here. In exam they won't ask you all the 4 items. They'll ask you 1 or 2 items. Or if they ask you all the 4, then it will be a 5-mark question. Then they'll ask you separate questions on each one. What is the undrawn? What is the risk factor on this drawn portion of CC? What is the risk factor on the drawn portion of packing credit? So any drawn portion, it's 100%. Or they'll ask you what is the risk factor on the undrawn portion of bill purchase? So 20%. Okay. Anything which is within 1 year or is always 20%. Okay. Now they'll ask you about term loan also. What is the risk factor on the term loan which is beyond 1 year? So that is what? 50%. Okay. So these figures we need to remember always. Okay. 20, 20, 50 and 100. So here the case study gets over for funded limits. Okay. Now we'll go for non-funded case study. Non-funded means this. Okay. All these things. Now these you need to understand first, because why? You won't not only will get this under case study, but you will get this under one-liners also. Okay, you will get these under one-liners also. So what are the one-liners and what I'll tell you as they come. Okay, financial guarantees. Here, these are all non-funded parts. Okay, in non-funded we have financial guarantees, acceptances, standby LC, clean LC, unconditional takeout finance, performance guarantees, bid bonds, conditional takeout finance and documentary LC. Okay. So these, how many are there? 3 plus 3 6 plus 3 9. In exam you won't get the 9 elements, you will be getting only 2 elements out of these 9, only 2. But remaining 7 somewhere they'll come in one liners, 1 mark questions. Okay. So you need to understand this financial guarantee. Okay. Now let's look at our earlier slide which I told you about this risk factor. See this 100%, 50%, 20%. Okay, apply this now over here. Financial guarantees means risk factor. Look at this part. This is 100% over here, complete 100%. Okay, up to here. Financial guarantees 100%, acceptances 100%, standby LC 100%, clean LC 100%, unconditional takeout finance 100%. Okay, all these are 100%. Now what do you mean by these terms? I'll just explain you in one line each term. Okay, financial guarantees, this we have already done. I have explained it in my earlier part also of this lecture only. Financial guarantee, no performance involved. This is simple for understanding. Acceptance, this is difficult. Many of you might not have dealt with acceptances. Here, whenever you have any bill of exchange, what do you mean by bill of exchange? Check, let's say this check. Okay, this check is a simpler term for you, right? So check or bill of exchange. In trade finance we have bill of exchange. This is the drawer. I'll write it over here. Drawer, right? Drawer. Okay, and this is the drawee. Okay, right? In your check also we have the same thing, drawer and drawee, right? So drawer and drawee. Now what do we do? In what do you mean by acceptance? See here, this drawer means he is generally the seller of the goods, and this person is the buyer. Okay, so what does he do always? This seller, if it's a due date payment, means usance payment. If it's a side payment, then directly the seller sells the goods and buyer pays you. That's a side payment concept. But if it is usance payment, usance means what? Future date payment. In that case what happens? Seller sells the goods and this buyer accepts this bill of exchange, and he tells the seller that, see, I will pay you on this future date, whatever that date is given. So this date is the future date, it's not the immediate date. Now what happens? This seller, let's say this transaction is done, seller has sold on 1st of June. Okay, and this buyer tells you that I will pay you on 30th of September. Okay, so this person has sent the goods on 1st of June only, and he will be getting the payment after 30th of September. So what happens in this case? When the buyer gives the acceptance, this seller doesn't agree with this buyer. He says that I don't trust you. In that case what he says, seller says, I don't want only your acceptance, I want the acceptance from your bank. Okay, so now what does the bank do? Bank gives an extra stamp of its that we accept this bill of exchange. And what does it mean? It means that if this drawee doesn't pay you, we will pay you. Okay, so here bank is taking the full financial risk. If there are more chances that he won't pay, then this bank has to pay. That's why this is known as acceptance. Got this point? Next, move on. Standby LC. Standby I have already explained, equals to guarantee. Okay, guarantee and standby are same in India. Similar, I would say. Not same actually, similar. Okay, logic is similar. Clean LC already explained, only bill of exchange. Okay, next, unconditional takeout finance. Now this is something different. Unconditional takeout, and this I'll bet you'll get a question on takeout finance. Okay, always remember, takeout finance is the important term in banks use nowadays, because banks have started funding for the long-term projects also. So what is takeout finance here? Logic is clear over here. Let me see. Yeah, I'll show you over here. If let's say you have to build a dam, okay, and it will take, let's say, 20 years, starting from all that land acquisition every year, or anything. Okay, so bank can finance maximum up to 10 years. Banks, 10 years finance is allowed. Okay, so if bank can finance only 10 years, what about the remaining 10 years then? What happens? Bank ties up with NABARD. I'll give you one example of NABARD. See here, NABARD is not the only institution. Okay, there are various other institutions also. Bank ties up with NABARD and tells NABARD that what you do is, you give first 10 years you finance. NABARD will finance. Okay, and after 10 years I will take over the loan from you. Second 10 years bank will take over the loan from them. Okay, bank will, what they may give. Please move on. Sorry, acceptance not clear. Okay, under this, see here, what happens is in under this takeout finance, bank will tell them first 10 years you finance, after that 10 years, next 10 years I'll take over the loan. So if somebody takes over the loan after 10 years, now there are two chances over here. This NABARD may not follow up and this loan may become NPA. Okay, and then bank has to take over this NPA loan. Now this is the point. If it's a unconditional, then bank says that whatever that loan may be, I'll take over the loan from you. And second part is this conditional finance. See this conditional. Here bank puts a condition that if it is a standard loan, only then I'll take it over. If it's a NPA loan, I won't take over. So this is conditional. So that's why unconditional takeout finance will always have a risk, huge risk, because the loan may become NPA. So that's why this is 100%. PGs you know, performance guarantees you know, bid bonds. Bid bond is the earlier part of performance guarantee. Always remember bid bond. Okay. Bid bond means what? See here, whenever you have to get a contract, let's say municipality. Okay. Whenever municipality gives a contract to somebody, for the initial getting the contract, they always ask for bid bonds. Once the contract is allotted to somebody, then they ask for performance guarantees. Okay, performance guarantee is always the next step after bid bond in generally in contracts. Okay, conditional I have already told you. Documentary LC you already know. Now let's move on to the topic. This question. See this CCF is 100% for these. For this performance part we have 50% over here. This is all 50%, and this documentary part we have 20%. Now it's easy. Once you understand this, it's easy. See this. Why should you must first understand these words? Why 100, why 50, why 20? Already explained to you. So financial guarantees, just multiply this as 90 into 100, 90, 80 into 100, 80, blah blah blah, everything. This much, this you'll be able to do it. Okay. So this is my final figure of 453, because we won't waste time in our calculations over here. Okay, because time is important for you. Next. So got this point. Non-funded is 453. Okay. Now before this non-funded, see this. First one funded was what? This CC part 290 I had it, right? And this non-funded is 453. So before going ahead, remember this batch which is coming up for December 2022 exam. Everyone must start focusing on that batch. If you are able to clear it in this exam itself, it's the best. If you are not able to clear it, go for this batch. Okay. So this batch will be covering the numericals, case studies, plus how many of you have liked this video? Please like this video. Everyone is watching, but nobody is liking, I think so. Many views, only 15 likes. I'll wait. Let's everyone please like the video first, because that gives you the better streaming portion. Here it's best for you only. What happens otherwise, if you 98 are watching or 150 are watching and you only 15 likes, first like, everyone like the videos fast. First like the videos. Okay, because what happens, the more the likes, the more streaming is better as per the YouTube rule. Okay, so always go for liking first. Whenever you watch any good video, not only this, whenever you watch any good video and you understand something, like that video, because it gives a better performance for that video in the future also and at present while live streaming also. Okay, so like this video first. And about this batch, we'll be covering the numericals, case studies, objective questions, complete portion of CAIIB, ABM, BFM and retail. Okay, so go for it, and the timings are also suitable, 8 PM to 10 PM. Okay, July 4th starting. Okay, just 2-3 days after this. Okay, tomorrow BFM, July 3rd, right, and 4th is the new batch starting. Okay, go for it. So I want the likes now. Let me see how many likes I am getting it. Okay, I'll wait for that for some time. Move on. First likes. Everyone should like this video as fast as possible. Okay, fast. Like fast. Okay, yeah. Now you guys are liking. Right, 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 right. Okay. Let's move on. Now, exposure and collateral. This is a new case study. Okay. Exposure and collateral equals to 100 rupees. The haircut for exposure as well as collateral is 25%. There is no currency mismatch in this case. Now remember what do I mean by this? Okay. Currency mismatch. So exposure and collateral both. Here, what there are always two types of things in any loan. Exposure means what? Loan disbursed. What is a loan given? Loan is exposure. Okay, and collateral you know already. Okay, so we won't go into this prime and prime security, collateral security. That's a JIB portion. Okay, now let's move on. So this one, exposure equals to 100 and collateral also equals to 100. The haircut factor for exposure as well as collateral is 25%. Okay. So now if the exposure this haircut factor is 25%, then I have to find the RWA. Now important part, always remember what is this haircut factor. Firstly, haircut factor means the risk which I have to add to my loan as well as the collateral. Now add means what? Always remember one part. In loan, how do I add the risk? And in collateral, how do I add the risks? Here, if I am giving you a loan of 100 and you are giving me a collateral of 100, okay? So if I am giving you a loan of 100 and you are giving me a collateral of 100, then what happens? For increasing the risk of that loan, I have to increase that loan part. And for increasing the risk of that collateral, I have to decrease that collateral part. So always remember one important part over here. In loan, you have to increase the haircut factor. In collateral, you have to decrease the haircut factor. Okay. So there is no currency mismatch. Currency mismatch means what? See this. Haircut factor are of two types, mainly three types. Okay. Which are the three haircut factors? I'll see this. One is HC. I'll write it over here. HC, HFX. And third one is maturity factor, MF. This is also a haircut factor related to maturity. Okay. See here, I am not seeing the likes over here. Where are the likes gone? Like them as fast as possible. Fast, like them. Okay. Yeah. So, where is the... Yeah. Let me go to this chat section. Yeah. Okay. Yeah. Done. Housing loan finance more than 10 years. Yeah, housing loan is a separate category given. All other loans, banks can finance maximum up to 10 years for general loans. But housing loan, there is a special category given by RBI that housing loan is a separate loan altogether. Okay, everyone. Because housing loan, some of you have objected that 10 years is the maximum loan for banking. That is for general loan, commercial loans. Okay. Move on. So HC, HFX and MF. See here, these are the haircut factors. What do you mean by HC? HC is for collateral. Collateral. Always remember. Collateral. Collateral. L-A-T-E-R-L. Collateral. Okay. HFX. HFX is for forex. Means what? If the loan is in rupees, and collateral is in forex, okay, then this HFX will be applied. If both the things are same, rupees only, then no HFX. Generally HFX is taken as 8%, okay, and MF is the maturity factor. Maturity factor happens when does maturity factor come in picture? Maturity factor comes in picture when the maturity of the loan and maturity of the collateral are different. Loan and the collateral maturity is different. Means what? If the loan is expiring in 3 years and collateral is expiring in 2 years, means FD I have taken as a collateral. FD is maturing in 2 years and loan is maturing in 3 years, then I am at a risk. But if the reverse case is there, then means loan is maturing in 2 years, FD is maturing in 3 years, then there is no maturity factor mismatch, because my collateral is for the higher amount, higher period. If something is for the higher period, some collateral is for the higher period, there is no problem for me as a bank. Okay. So let's move on with this. Now, what is the case again? This is a simpler case. See this. 25% is the haircut factor. So 25% means what? See, this loan is given as 100 rupees, collateral is given as 100 rupees, haircut is 25 rupees. See this, I'll write it over here. Loan equals to collateral equals to 100. Okay. So haircut factor HC, I'll write it, equals to 25%. No MF and no HFX here. In this problem there is no currency mismatch, so nothing. No maturity factor given, so nothing. So only HC. So 25% means what? For loan I'll have to increase. So loan becomes what next? Loan equals to 125. 25% increase. Remember this. What did I write over here? Loan is increase, collateral is decrease. What is the collateral then? Collateral equals to 25% decrease, means it becomes 75 now. Okay. So loan is 125, collateral is 75. So now what is my RWA? RWA means what? What is the unsecured portion? Simple word of RWA is unsecured portion. What is my unsecured loan? Okay. So unsecured portion of my loan is 125 minus 75, that is 50. Okay. So earlier, without this applying this haircut, what was my unsecured loan? No, 0, because 100 rupees loan, 100 rupees collateral. But after applying the haircut, what is the case? I am getting 50 rupees, my 50 rupees are at risk. Okay. So this is the RWA. Now why do we take all this? What is this RWA business? Why are we taking all this? Why this RWA is required? Because this comes in that CRAR formula. CRAR equals to what? Capital upon RWA. Okay. Now next one. This is a simple one. Now I have explained you the theory. Will go fast on this loan in this case. Okay. Exposure of rupees 100 lakhs is backed by financial collateral A plus debt security of 30 lakhs. The tenor of the exposure is 3 years and the residual maturity of the financial collateral is 2 years. Haircut factor is, on collateral is 6%. The table of maturity shows 25% for the remaining maturity period. So see here, there are various factors in this, and remember this will come to you as a problem. Okay, generally it comes as a 1 mark only. So this is a difficult problem for solving for 1 mark. Okay, what is given? There are 2 parts given over here. Let me see. Yeah, there are 2 parts given over here. What are the 2 parts? One is a loan, second is a collateral. Okay, loan is what? 100 lakhs. And then what? Backed by security of 30 lakhs. Here collateral is of 30 lakhs only. And then also there are problems in this collateral. The tenor of the loan is 3 years, whereas the tenor of the loan collateral is what? 2 years. See this, tenor of the collateral is 2 years only. Now haircut for collateral is given as 6%. Remember this now, collateral. Is there any haircut given for loan? No. So don't apply anything to loan. Okay, so loan equals to no HC in this case, no haircut I will say. Okay, no haircut in this case. Collateral, there are 2 haircuts over here. One is what? This HC. What were the three collaterals haircuts I told you? HC, HFX, right, and MF, maturity factor, right? So which are the haircuts to be applied over here? HC is to be applied. Yes, it is there. Is there any change in currency? No. So HFX is 0. What about the MF, maturity factor? Yes, it is there, because collateral is maturing in 2 years and loan is maturing in 3 years. So that's why MF will be there. So there is a formula for MF now. How to get this MF formula? I'll show you. See this. First, always apply this here. Go in this sequence only in exam. First HC, then HFX, then MF. Go in this sequence only. Never change the sequence. Never get MF first. Okay. If you mistake somewhere in HFX and HC, it may be okay. But if you mistake in MF, maturity factor, the whole problem is gone. Okay. So important point is MF should always be kept at the end, maturity factor. Okay. So go in best ways I would suggest you go in this sequence only. A, B, C, D. C comes first, then F comes, then M comes, right? So C, F, M. Go in this A, B, C, D sequence only. Okay. So apply this HC now. Say this. Firstly, no loan HC, right? No, for loan nothing. So value of exposure after risk mitigation is current value of the exposure minus value of adjusted collateral for haircut and maturity mismatch. Here both you have to apply. So first apply haircut. So value of adjusted collateral for haircut is what? 6% it is given, right? So collateral is what? 30, right? See this collateral is 30 lakhs. So 30 C over here, 1 minus HC. HC is 6% over here and HFX is 0. So 1 minus 6 is percent. This is, you can take it to 0.06, okay, because it's a percent part. So 94%, okay. So 30 into 94%. This you can take it as 100 also, huh? Because we are taking it in percentages. So 30 into 94%, you get it 28.2. Now HC is over. HC is over. Now you have to apply MF, maturity factor. Value of the adjusted collateral for haircut and maturity factor mismatch is, see this, now this is important part. This is C into T minus MF upon T minus MF. Now what is this small t, what is this bigger T? See this capital T. C is collateral, but this collateral means what? Not the original one. This is now 28.2, which we have got after HC, okay. This T is for the collateral, period of that collateral. This T is for the loan, okay. So remember, this is 2, this is 3. So apply this now. 28.2 into 2 minus 0.25 upon 3 minus 0.25. Why this 0.25 given over here? See this in the problem. 25%, okay, maturity factor. So apply this 0.25, okay. So then you will get the answer as 17.95. Okay, got this one, everyone? Getting this point? Type yes if you have understood. Type yes firstly, because that will give me something, good idea whether you are understanding this problem or not. Okay, type yes fast, everyone. Yes. I want to see whether you have understood or not. And if you have any query, you can directly ask me over here also. What's the issue? Okay, I am there live. Okay, so type yes, everyone fast. Type yes. Again, I am not seeing the likes. Where are the likes? Go on with the likes fast. Everyone like this video. Everyone like this streaming as fast as possible. Okay, so let's move on. Next. Now these are simpler ones. I won't waste my time on this and your time on this. Exposure of 100 lakhs is backed by the lien on FD of 30 lakhs. There is no currency mismatch. See this. Again 3 HC, HFX and this. HC, haircut factor, HFX and MF. These three. Always remember these three only in any collateral problem. So HC is generally applied to other banks collateral. Means if I take a collateral from some other institution, other bank, then this HC is applied. HFX is for forex. So is this for any other bank? Lien of the same bank. So HC is 0 over here. HFX is 0 over here. Maturity, there is no mismatch of maturities. This is also 0. So problem is very simple now. Nothing, just 100 minus 30, 70. Okay, that's it. That's the problem. Okay, so net exposure is 70 lakhs over here. What is my VAR? See here, words can be different in your exam. They can ask you for VAR, they can ask you for net exposure, anything they ask you. Remember, it's only loan minus collateral. If there are haircuts, apply the haircuts and then go for it. Okay, got this point? Yeah. Next. Now this is a difficult case study. Okay, difficult means it's a 5-mark case study which will come to you in exam. And remember, I have taken only those questions in this marathon which may come in exam. Means I won't say will, otherwise you'll say have you set the paper. It's not that. 90% chances of these questions, all these questions are coming in the exam. Okay, so in a bank, tier 1 capital is given as 1000 CR, tier 2 capital is given as 1200 CR, risk weighted asset for credit risk is 10,000 CR, capital charge for market risk is 500 CR, capital charge for ops risk is 300 CR, tier 1 CRAR and tier 2 CRAR. We have to find this. Okay, now this case study comes for 5 marks in almost every exam. Every exam. Okay, I have seen this. Okay, so how to solve this? Firstly, importantly, let me come to this. First part is this. Okay, always remember our target is what? CRAR formula. CRAR equals to capital upon RWA. Okay, CRAR equals to capital upon RWA. Okay, this is your prime target. This is your prime target. Okay. So capital is always of the two types, T1 and T2. Okay. There is also T3 capital, but T3 is not used in these calculations. Why? Because T3 is emergency capital. Emergency. I'll give you one important part, although it's not a part of this case study, but I'll give you about this, tell you about this. T3 is a emergency capital, and that comes due to market risk only. Remember this word, market risk. Okay. Only because of this market risk, this T3 will arise. What are the three types of risks? Operations, see this. There are three types of risks in basically three. Which one? Credit, ops, and third is this market, right? Market. Okay. So remember this part, market. This emergency capital, T3 capital, is not applicable to credit or ops. It is only applicable to market risk. Why? Because market risk is out of your hands. Means what? Russia invading Ukraine is a market risk. America, US Fed increasing the bond rates is a market risk. COVID situation is a market risk. But your employee creating some problem is a ops risk. That you can definitely control it. Your customer not paying the loan, okay, that's a credit risk, because it means you have not done that study of that customer properly. So these two things can be controlled and they are within the hands of the bank. But these things, market risk, is not in the hands of the bank. So that's why, remember, T3 is always for market risk. It is never for the credit and ops risk. Okay. And one more important part about this T3. Remember, these are, why am I giving this? Although this is not a part of the case study, but this will come to you in the exam. Okay. T3 should always be 250% maximum of T1. Okay. Maximum, this is maximum 250%. Always remember this. 250% of T1, okay, and that is taken only in the case of dire situations, it means difficult situations. Okay. Now let's forget this T3. Now we are in this case study. So T1 and T2 only. Okay. T1 and T2. So there are two types of capitals. What is T1? What is T2? Everyone knows this or no? T1 is a free capital. Free. I would give two words to this. Okay. Free. And second word for T1 is this going concern. Going, remember this word, going concern. And T2 is what? Paid capital. Paid. Okay. And this is gone concern. Gone. Okay. So remember these two words, going concern T1, gone concern T2. Gone means what? I have to pay for that. Going means what? I don't have to pay for that. Okay. That is the meaning of this T1 and T2. Got this point? So our focus is only T1 and T2 in the numerator, and in the denominator our focus is, we have three types of risk. Okay. These three. Okay. I'll just write the first words now. Credit, ops, and market. So our focus is RWA for all these three. Okay. So which are the three givens here? Let's see first part. Okay. Here only we can solve this. See this case study. I'll be taking roughly 4, 5, 6 minutes for this. But in exam you have you can get this whole case study in 30 seconds if you know it. Okay. So remember. Okay. Let's move on. So now tier 1 and tier 2. Now tier 1 means what? 1000 crores. Now in tier 1, if I am having 1000 crores, remember one important rule for tier 2. T2 cannot be greater than T1. T2 cannot be greater than T1. Remember this important rule for T2 and T1. So even though T2 is given as 1200 CR, you won't take it as 1200. You will be taking it as 1000 only. Point number 1 about the capital. Okay. Next. About this, till December, follow till December, this, okay. So, T2, RWA, risk-weighted assets. So, what are the risk-weighted assets here? For capital risk, credit risk, it's already given. See here, our target is finding RWA. RWA for credit risk is already given as 10,000 CR. For market and ops, it's not given. So, that's what we have to find out. This is our question mark. Okay. So, let's solve this now. See this. Always here, I am always doing the advertisement for this, because after all, As you work, we also work over here. Okay, so that it's a part and parcel. You'll find this everywhere. Okay, move on. So RWA for credit risk 10,000 CR. RWA for market risk. Market risk, see this. Again use the same formula. CRAR, I'll just write CR now, equals to capital upon RWA. Okay. So now just short forms I'll write it. So credit risk CRAR for as per RBI is 9%. So 9% equals to capital upon RWA. What have I to find out? RWA. Now capital is given 500 for credit, right? CR it's given over here 500 CR. See this. Okay. So this I'll use it. Okay. So RWA equals to what? 500 upon 9%. That is 0.09. So that's why we get it what? RWA for market risk equals to 500 upon 0.009. So it is 5556. So RWA for market risk I found out. Now same for ops risk. 300. This is a capital given. 300 upon 9%. 4 times 3. So now I found out all the RWAs. So total RWA is what? 10,000 plus 5556 plus 4 times 3. So 18,889. This is my total RWA now. Total RWA over here is 18,889. Now get back to the capital part. 1000 CR is the capital tier 1. T2 can be maximum up to 1000 CR. So total capital is what? T1 plus T2, right? 1000 plus 1000. So I've got it 2000 over here. Now what is the question to me? What is main question asked to me? Tier 1 CRAR and total CRAR. So tier 1 CRAR is what? Eligible capital. Again same formula. Capital upon RWA. What is capital for tier 1? Tier 1 capital is given as 1000 CR, right? See this over here. 1000 CR. So 1000 upon this total RWA. 18,889. Okay. So do this into 100. Of course it's into 100. Whenever you find a percentage, it's always into 100. Okay. So 1000 upon 18,889 into 100. So you'll get this as 5.29%. Now what is the total CRAR? Again same logic. Capital upon RWA. What is the total capital? 2000. 2000 upon 18,889. So what is the answer you are getting? 10.59%. Okay. 10.59. Remember, this is the 5-mark case study. They'll ask you some various questions. What is the RWA for market risk? What is the RWA for ops risk? 1 mark over here, 1 mark over here. What is the T2 capital to be taken? 1 mark over here. Then they'll ask you tier 1 CRAR, 1 mark over here. Total CRAR, 1 mark over here. Plus, they'll ask you one important question over here now, which I will also ask you. That is 5.29% is tier 1 CRAR. Total CRAR is 10.59%. Okay. Now my question comes to you. Is this CRAR, tier 1 CRAR correct for this bank? Or is this bank losing? Is it bad for this bank? Is this tier 1 CRAR correct or is it bad for this bank? That's what my answer required is. Is this total CRAR correct for this bank or is it bad for this bank? Now this is what you have to answer. Okay. So is this correct or wrong? Or should the bank do something in this? Okay. Okay. Answer fast. Why not divided by 0.09? Okay. Yeah, this is the percentage part. Why not divided by 0.09? Okay. Yeah, it is divided by 0.09. See this. See this 300 upon. It is upon. Look at this upon. It is divided. Okay. Because remember, RWA is what? Capital upon CRAR. It's always divided. Okay. Whenever you use this formula only, it's after all the juggling between these three formula only. CRAR, capital and RWA. If you, two are given, one is to be found out. Okay. That's what. It's always this. So what is the problem over here? Minimum should be here. Now look at this slide. Minimum should be what? Total CR required, CRAR as per the RBI is 9%. Now remember, this 9% is not the final one. Okay. 9% if you are having the insurance business. If your bank is doing the insurance business, then it is 10%. Okay. If you are a public sector bank, then it is 12%. These are the separate rules given by RBI. But for calculation's sake, we take this as 9%. Okay. What is the Basel requirement for CRAR? Everyone, what is the Basel requirement for CRAR? Everyone, can anyone give me Basel requirement? Okay, for CRAR, total CRAR. Basal requirement for CRAR is 8% and RBI has given us 9%. Okay, so we are 1% higher, we are safer. Okay, now coming back to the CRAR part, 9%, how to bifurcate between this? See here, 9% is always bifurcated into two parts, T1 and T2. T1 is 7% and T2 is 2%. T1 is paid free capital, T2 is paid capital. Okay, so now this 7% will always be again be divided into two parts, CT1 and AT1. CT1 means what? Common equity tier 1. Remember this, common equity, common equity. What is the meaning of this common equity word? Understand this. Okay, first I'll give you the figures. CT1 is 5.5% and AT1 is 1.5%. Okay, AT1 is 1.5%. T2 is what? 2%. Okay. Okay. Now move on. Remember this. CET1 is 5.5. So what will be included into CET1? Equity, net profit and reserves and surplus. All this is free capital. This is my total, my income. Owner's income actually. Okay. All these. I don't have to pay anything on this. What will be included in AT1, additional tier 1, PNCP and IPDI. Remember, PNCP means what? Perpetual non-cumulative preference shares. What is perpetual? Firstly, what is the preference share? PNCP. PNCP is a dilution to preference shares. In PNCP, what happens? Perpetual non-cumulative. Okay, non-cumulative means what? The meaning of non-cumulative is if I don't pay you the dividend this year, next year it's not compulsory for me to pay you the last year's dividend. Means this year which I have missed. It's not compulsory for me. So that's why it's called as non-cumulative. And perpetual means long term. This perpetual means it will go on for years and years and years. Okay. This will be, let's say, 100 years bonds. If you see Saudi Arabia, Aramco company had issued a 100 years bonds some 3 years back. 100 years bonds. Okay. Government generally issues the 30 years bonds. If it is more than 50 years, it's taken as generally perpetual. Okay. So that is perpetual, and second is IPDI. Innovative perpetual debt instruments. Here, although these are not a part of this case study, but you must understand all these things. IPDI, innovative perpetual debt instruments. So innovative perpetual debt instruments means these are a similar type of PNCP only, means innovative, perpetual, again long term, and debt means what? I have to pay something, but if it is perpetual, then I have to pay very less amount or negligible amount or nil amount. Okay. Remember one important part for this IPDI. This IPDI, remember, I'll tell you again, underline this. You remember this, you'll see this as a question in exam. IPDI should not be greater than 15% of T1. IPDI should not be greater than 15% of T1. This will be the exam question. Remember this. IPDI should not be greater than 15% of T1. Got this point? Okay. Now T2. T2, there are various queries everyone is having. Revaluation reserves is to be taken in T1. Then revaluation reserve is to be taken in T2 or what? Forget everything. I would say follow your Macmillan. What does Macmillan say? Okay. Macmillan says T2 is revaluation reserves. It is taken as 55% discount. Okay. Macmillan says even RBI circulars from 2015, if you check, they always give you revaluation reserves at 55% discount only. Okay. So take whatever is given to you in books, because the papers are set mostly by the books. Okay. So 55% discount, take it as 45%. Means what? If revaluation reserves are given to you for rupees 70, then you have to take 70 into 45%. Similarly, subordinate debt. Subordinate debt is to be taken 100%. This is a T2 because these are all paid capitals. Second is contingency reserve. This is very important. 1.25% of the RWA or the given figures. Here I'll write it over here. 1.25% of the RWA or given figure. Given figure. Okay. Means what? They'll give you one figure for contingency. We'll have this case study over here also. Okay. They'll give you one this contingency reserve. That it is, let's say, 200 CR. And you have to calculate it for 1.25% of RW also. Then whichever is minimum, you have to take that. Okay, so remember this slide very properly. Okay, let's move on. Yeah, now this is the second part. Second part is this regarding the risk weights to bonds. Now see here, first what did we see? We saw the risk weights to these products, LC, standby LC, all these funded limits. Okay, now the risk weight is for the ratings. Okay, ratings of the bonds which I give or which I take. Okay, so if I am having this triple A rated bond, the risk is 20%. Always remember, the best bond is triple A. The worst bond is triple B and below or double B and below. Okay. So triple A rated bond, I am having it as this 20%, double A rated 30%, single A 50%, triple B 100%, BB and below 150%, unrated is 100%. Now these are long term bonds. There are always two types of bonds. One is long term, second is short term. Okay. Short term, the ratings are not like triple A, double A something. They are always with numbers. Okay. So A1 plus, A1, A2, A3, all these. Okay. Got this point? Yeah. So A1, A2, A3, A4, A5, all these are short term. Remember, in exam, remember you might see here CAIIB is always on basics, whether you understand the basics or not. So in exam, they'll always ask you short term and long term. Okay. So rating style of this long term is always all these AA, BBB numbers, alphabets basically, and this is numbers. Okay. So coming back to the question, triple A, double A, all these things, remember. How to remember this word? Because this is very difficult for everyone to remember here. It's always, even I found it difficult when I was in CIB. Okay. So how to remember this? I'll definitely tell you. Whenever you go out of this slide, this marathon, you'll remember, you'll forget everything, and these numbers you won't remember at all. I'll give you the trick. See this. Very simple trick. 20 plus 30 is what? 50. Right? 20 plus 30 is 50. Then 50 plus this 50 plus 50 is 100. Right? 100 plus 50 is 150. That's it. What's remaining now? Right? 20 plus 30 is 50. 50 plus this 50 is 100. 100 plus 50 is 150. And that's it, done. What's there to remember now? That's what I'm saying. Always remember, in life, never mug up the things. Try to understand the things. The more you understand, the easier it will be for you to, because whatever you have understood, ABCD, you have understood in your childhood, right? So do you forget that? Tables up to 10 at least. I won't say up to 20, because I know bankers don't know the tables up to 20. Even I understand that. Okay, but at least up to 10. Have you forgot that? Because you have understood those tables. Basics of life, you have understood that. Okay, whatever you understand, it's always easier for you to move, to remember. Okay, so 20 plus 30, 50. 50 plus this 50, 100. 100 plus 50, 150. Right? So that's the way it is to be done. Similarly over here also. Okay. Now let's move on. Only this is important for you in exam, nothing else. Don't read whatever is given by me over here. Okay, read only this much. See here, in life it's always important to know what to do or what to read. But in life it's always important to know what not to do and what not to read, isn't it? That's also important. Because if you have ample time, you can go on reading anything and everything. But if you have only one day, why do you read all these stupid things? Okay, only read what is given for you in the exam. Okay, this, done. Okay, move on. Now this, again the new risk weight. Again, this is a part of an exam question. Any loan below 30 lakhs. Okay, remember there are three categories: 30 lakhs, 30 to 75, and next is above 75. Okay, so any loan below 30 lakhs. Okay, and loan to value ratio means what is the value of that property versus the loan. If it is less than 80, then the risk weight is 35%. If the risk weight is a loan to value ratio is between 80 to 90, then the risk weight is 50%. Okay, got this point? And now you'll ask me one question, but if the loan to value ratio is between 90 to 100, then the bank is in trouble, isn't it? If the loan to value ratio is between 90 to 100, then the bank is in trouble. The bank is taking a huge risk. Never a prudent banker will never take a risk more than 90% on LTV. Okay, if you are taking a risk, then either you are corrupt or you are not knowing the banking conditions. Either of these two things, right? See here, when can a banker do a problem mistake? Either he doesn't know anything or he is corrupt minded. Only these two things are happen. Okay, so if you are taking a this LTV more than 90%, then either you are corrupt or you don't know the market conditions. Okay, so LTV should be always, okay, less than 90%. Even I would say 90% is not given by many banks. Okay, they'll stick to 80% only. Okay, so 80% is 35% risk, 80 to 90 is 50%. Now more than 75, now more than 30, sorry, 30 to 75. LTV less than 75%, risk weight is 35%. Okay, LTV 75 to 80, it is 50%. Remember, for 75 lakhs, the LTV, the ratio is not 90%, it is 90%, 80%. Why? Because the point is, the more you give the loan, the more safer you have to be, the more cautious you have to be. So that's what I doing over here. You are reducing this LTV from 90 to 80. Now for this, this what above 75 lakhs, LTV less than 75%. Remember this 90 upper limit, 90, 80, now 75, because the loan is increasing. So if it is increasing by increasing to 75 lakhs, my LTV should be less than or equal to 75% only. So now the risk factor is 75. Remember all these 5 figures. Okay, now what is the formula to remember? As I told you about this 20 30, 20 plus 30 is 50, 50 plus 50 100, 100 plus 50 150. What is the formula for this? No formula, because nothing is required. 35 50, 35 50, what is to be remembered? Everything is 35 50, only this is 75. So why should I give you any formula for such simple thing, isn't it? Move on. Now next, risk weight on NPAs for specific provision will be calculated as under. Now this is another important part. Provisioning. Let me see. Yeah, I have taken this slide over here. This provisioning. See here, whenever the provisioning is less than 20% of the NPA, total NPA outstanding, the risk weight is always 150%. See this RWA. There are certain things which you need to remember. Okay, so RWA. When the risk weight is provisioning, this is provisioning. I'll write it over here. This is provisioning and this is RWA. So if the provisioning is less than 20%, RWA is 150%. If the provisioning is 20%, means at least 20% to 50%. So the risk RWA is 100%. If the risk weight is greater than 50%, then the RWA is 50%. Okay, got this point, everyone? Now I'll show you better in this slide. This slide shows you better things. Okay. See this. Let me see how many of you are able to see this. See this. Substandard. What are the types of loans? Substandard, doubtful 1, doubtful 2. Generally, okay, in NPS, right? And one is standard. Okay, standard is different part. We'll only focus on NPA part. Substandard. Substandard, we have two parts again: secured, unsecured. Secured, as per the latest RBI circular, it's 1525. Okay, so secured, substandard, secured 15%, substandard, unsecured 25%. This is the provisioning. Remember, provisioning. Okay, now if the provisioning, what did we say? If it is less than 20%, less than 20% means not 20%. Remember this. It should be less than 19.999. Then it's this less than 20%. Okay, then the risk weight is 150%. Okay, unsecured loan 25%. So risk weight is 100% over here. Got this point? D1, secured 25, unsecured 100. Got this point? 2500. Again apply the same rule. 20 to 50, then beyond 50, 20 to 50. This is 100%. Now remember one important part in the RBI circulars always. Whenever you read that RBI circular, always remember firstly, one, the date of that circular. If you don't miss on that date, you will go somewhere else. And second, to whom it is addressed. Whom? Means what happens? RBI addresses various circulars to various banks. Means to cooperative banks they have separate circular. To commercial banks they have separate circular. For example, I'll give you this substandard. For commercial banks it is 1525. Remember, see this. Commercial banks it is 1525. But for cooperative banks it's all 10%. If you see the latest RBI circular of April 1, 2022, you will see cooperative banks. I'll write it over there here. Cooperative banks, okay, it's all 10%, whether it's secured substandard or unsecured. Okay, only SS, only SS. So secured substandard or unsecured substandard. But for commercial banks, commercial means what? Private and nationalized banks. Okay, so these banks it is 1525. Okay, that is the change they have made. That's why I always say, whenever you view any RBI circular, always look at date and to whom it is addressed. Okay, Sir, what is the answer for tier 1 capital question and tier 1? 5.29%. No, bad for banks. 5.29%. Ayushi, somebody has asked me this question. What is the it means minimum criteria? Minimum criteria is T1 capital is 7%, right? So 5.29 is bad for banks. Always remember, 5.29% of tier 1 capital is bad for banks, okay? And that 10.29 is good for this. Total tier 1 was good over here. See this slide. This question, which one? This. 5.29% it's bad. 10.29% it's good. So what the bank has to do? If in this case the bank has to increase this tier 1, it will have to increase what? Tier 1 capital means what? It will have to give more shares, issue more shares. It will have to increase its net profit. Okay, it will have to increase its R&S, reserves and surplus. Okay, got this point? Always remember, for increasing the tier 1 capital, what has the company to do or bank has to do? The company or bank has to increase share capital, free share capital, not preference. Okay. Second, it has to increase this net profit, means increase the margins of the business. Okay. And third one, reserves and surplus, but that comes from net profit only. To increase the tier 2 capital, what have they to do? They have to take more loans, issue more bonds. Okay, that is the way. But always remember, it's bad for any company to take loans. Okay, it's good for any company to issue T1 capital. Okay, so always company prefers T1 capital because nothing is to be given on that, free capital, right? Coming back to our problem over here. Okay, so here, so everyone got this. 2500 here, D1 secured 25, unsecured 100. Okay, D2 secured 140, unsecured 100, right? So now the provisioning will also change, and loss is completely 100%. Remember one important part about this loss. Many of us feel that any loan will go through these steps only: standard, then substandard, then D1, then D2, then loss. It's not that. Loss can happen anytime. A standard loan can become a loss loan immediately without going through these steps. A substandard loan can go to loss loan without going through D1, D2. Similarly for this, okay? Understand this concept very clearly. Let's move on. Yeah. Popular Bank is a leading bank in the public sector, and its balance sheet on 31/3/2008 reveals the following: interbank call money, market lending, and refinance loans to other banks. So what is this? See this. This is a bank, and these are its, what do you say, lendings. Okay, lending. So what are these lendings? Always as per this problem, the lendings are of two types. One is call money lending, and second lending what they have done is loans. Okay, one is call money lending, second money what they have done is the loan lending. Okay, so now understand this. This is again I am telling you, this is the exam case study. Exam case study. You will see these in exams tomorrow, and all the batches will see this. It's not that one batch will see, other won't see. Nothing. Every batch will see. Only the point is, all the 5 elements won't be given. They'll give you only 1 or 2, because after all it's CAIIB 2 hours paper. This I am having complete 2 hours over here. Means I am having infinite time with me. Here you have only 1 or 2 hours over there. Okay, so all the elements won't be given. 1 or 2 will be given. Okay. Now coming back. Remember one basic rule about this. The rule is, let it be call money, let it be loans, okay, to anything. Loans, refinance, let it be anything. You call me, suppose if I have given just a short-term loan to somebody, or I have given it for some udhari, I would call it, right, to somebody, some company. Let it be anything. It's not at all concerned about what type of credit it is, call money or this loans. Everything depends on the bank and the CRAR. I'm talking specifically for CIIB problem. Everything depends on the type of bank and CRAR. So what is the rule for this here? Firstly, understand the figures. 500, 300 here. 500 crores is given to what? Public sector bank with CRAR 10%. Remember, these words are very important. Public sector bank. Okay. 2 factors you have to look at: type of bank and CRAR. Okay. The 300 crores given to what? Private sector bank with CRAR of 14%. Okay. 200 crores given to what? Scheduled bank with CRAR of 8%. Okay. Look at these figures also. 2 things you have to watch always. 50 CR given to non-scheduled bank with CRAR of 16% and 50 CR to another non-scheduled bank with CRAR of 5.5%. So look at the type of bank and the CRAR, because that will make the difference now. These figures you can get it anytime, whenever you want, right? It's given in the problem itself. Total is 1100. See this, if you total this, you'll get it as 1100. Forget this, okay? So focus on only what is the, you should be like that Arjun in the Mahabharata. You should only focus on the eye of that fish, okay? Nothing else, okay? So public sector bank, type of bank and CRAR. Move on. So what will be the amount of capital funds required for this purpose, and what will be the minimum or maximum amount of tier 1 and tier 2 capital? So what is the capital fund required? That is the question. So what is the capital fund required? Okay. Before that, this loans also, same logic. No difference. Okay, loans, call money, let anything, same thing. Only focus on two things. Type of bank, CRAR, right? Type of bank, CRAR. Scheduled bank 5.5%. Non-scheduled bank 15%. Non-scheduled bank 8.5%. Again the same question. Minimum capital requirement and tier 1 and tier 2. Okay, let's move on. So, which comply with CRAR 9,000 this year. What is the important part now? Remember this, that these two slides are very important from the exam point of view. Any scheduled bank with minimum CRAR of 9%. Risk weight is 20%. Again I am telling you, type of bank, CRAR. Scheduled bank, risk weight 9%, this CRAR 9%, risk weight 20%. Got this point? Non-scheduled bank, minimum CRAR 9% here. This was also minimum. Minimum CRAR 9%, risk weight is 100%. CR, same thing, everything is same. CRAR same, but only the difference is scheduled and non-scheduled, okay? So what is the difference between scheduled and non-scheduled? It's in the second schedule of RBI, right? Okay. So this is done. Next, claims on other scheduled and non-scheduled banks. Here, these are the two main criteria with CRAR less minimum 9%. But if something is a different bank, means same banks, non-scheduled and scheduled are everything, but CRARs are different, then what? Now look at this table. CRAR for 6 to 9 for scheduled bank. See here, earlier it was minimum was 9, right? It was more than 9. Okay, firstly, before going ahead, are you understanding this? Let me first get it from you. Are you understanding this? If you are understanding it, type yes fast. If you are understanding this, type yes fast, because I want you to understand. Tomorrow you are going to give the exam, not me. Okay? Type yes if you have understood this. Fast. Type yes. I'll take a breather over here. Type yes if you have understood it. Yes, yes, yes. And what about the likes? What about the likes? Where are the likes? Increase the likes. I want everyone to like this video. Okay? I want everyone to like this video. Remember this. Everyone like that. I'll wait for 2 minutes. Okay? No, I'm not in a hurry. Okay? I'll wait for 2 minutes. Like this video. Everyone should like. Otherwise what happens, YouTube will stop this this live streaming, okay, and you will be in the trouble, because live streaming is very important. Means if you have to go for the live streaming, the number of persons who are watching must like it. So what happens, if you have equal number of likes and equal number of views, then what happens, means at least they give you 25% leverage, YouTube, okay. So if I am having 100 views or 1000 views and I am getting 750 likes, then it's okay. But if it is less than 750, then YouTube stops this streaming with the means it gives a buffer to that, okay. So go for it, immediately like it. I want the likes from everyone now. First like it, okay, and then answer me whether you have understood this. Are you getting this, or am I going too fast, too slow? Everyone, yes. Am I going too fast, too slow? Type yes if you have understood this. Everyone. Everyone, yes. Fast, 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 yes. Okay? Getting it, everyone? So I'll move on with the case study now. Okay? Chalo. 6. CRAR 6 to 9, it's 50%. Here, scheduled bank, it's 50%. Non-scheduled bank, 150. Here, non-scheduled is always given a stepbrother's treatment. Why? Because it's a non-scheduled. Non-scheduled means it's a huge risk to put that money in that bank. Okay? So scheduled it's 50, non-scheduled 150. CRAR 3 to 6. Scheduled it's 100, non-scheduled it's 250. CRAR 0 to 3, scheduled it's 150 and non-scheduled it's 350. And CRAR negative less than 0, let it be scheduled or non-scheduled, it's 625%. Okay. Remember, this is the exam question. Negative CRAR, scheduled or non-scheduled, anything it's 625%. Okay. Yeah. Next. No, we'll continue this session up to next one more problem. Okay, module C case study I'll be covering after this, and then we'll stop this. Okay, because module C case study you'll get it in exam. Okay, next move on. So now here, before again my advertisement part. So we are going on with this batch. Join this batch as fast as possible, just starting from July 4th. Okay, December 2022, ABM plus BFM plus retail, everything will be covered. I'll show you live also how to do that, means join that and do all the things. I'll show you that also. Okay, so let me see if it is possible now only. Let me see. Okay, let me see, wait for 1 minute. Go to Adda 24/7. Okay, I'll show you live over here, because even whenever we are studying, we have to look at the means future part also. See this. Go to Adda 24/7. On Adda 24/7 you'll see all these. See this front page only. Click on JIB CIB. How to go for these batches? JIB CIB. Okay. Once you click on these batches, remember this CIB November December English batch. Click on this. Okay. In this English you'll see all the batches now. See this batch. Okay, click on the first batch, 17,999 fees. Okay, I'll show you. Use this code. Okay, this session which I am doing, use this code Y432. Okay, this code Y432. See this. Firstly, look at this. You read this here. 120 plus hours of coverage for ABM, BFM, and retail. Ebooks. Then module-wise topics are given. Module-wise tests are given. Everything is given. Okay. Now, one sec. Everything is given. So these revision videos are available. So if you miss out on certain class on some day, you can definitely go for this revision videos also. Now coming to the fees part. Okay, fees part is this 17,999. Click on view offers. Okay, once you click on view offers, look at this. See this fees is seen as 17,999. What you do now is apply this code Y432. Y432. Apply this code. Once you apply this, you'll get this. See this. See the fees now. Y432 reduces this using this code. It is 80% off. So the fees has become what now? 3599. Okay. And once you clear the CAIB, in how many months will you recover this 3599? You'll recover it within 3 months. 1300 is the average increment, right? So 3 months you'll be recovering it. Okay. So go for this batch as fast as possible. Okay. But definitely, first clear this exam. I would be the happiest person if you would clear it tomorrow itself and you don't require this batch. But if you can't, go for this batch. Okay. So let's move on with our topic again. So yeah, we were here. Okay. So coming back, this steps for solution. How to solve this case study? This case study. Okay. How to solve this? Always remember, first apply CCF calculations, then RWA. Always first CCF. So how to apply this CCF? See this. Risk weight. Apply this risk weight. 500 crores was given to what? See this bank. Again we'll have to go back to all these slides. Okay. 500 crores was given to public sector bank with CRAR 10%, greater than 9%. Okay. So CRAR greater than 9%, public sector bank risk weight is 20%. So got it, 20% over here. So 500 into 20% over here. Similarly, the second one, 300 crores was given to what? Private bank. Private bank is what? Again this commercial bank, scheduled bank only, with CRAR of 14, greater than 9. So again, what will I have? This is 20% over here. Here it is 20%. Okay. Now next is what? Scheduled bank having CRAR of 8%. Here now the CRAR has reduced for me, right? And it's a scheduled bank. So scheduled bank 8% means here this scheduled bank 6 to 9, right? 50% is the risk weight. So 50% is this factor over here. Next is what? Non-scheduled bank, CRAR of 16, greater than 9. Okay. So again non-scheduled, but this it is what is the case over here? 9 here. Non-scheduled minimum 9% is 100%. Okay. So I'll put this as 100% over here. 100. Okay. And last one is what? Non-scheduled CRAR of 5.5, so less than 6. So 3 to 6 criteria. Okay, see this 3 to 6 criteria, non-scheduled bank 250%. So I'll put this category as 250% over here. So 250. Okay, got this point over here, 250. Now for the other case also same logic. Scheduled bank 6 to 9, no, 3 to 6, right? Scheduled bank 3 to 6 means, see this, scheduled bank 3 to 6, 100%. Okay, see here 3 to 6. Why am I showing you again and again? So that you remember this. Okay, what is this? 50% or 100? What was that? Yeah, scheduled bank 3 to 6, 100%. Okay, so 100% over here. Scheduled bank here, non-scheduled bank 15% means CRAR greater, so it is again 100%. Okay, non-scheduled, see this over here, non-scheduled CRAR minimum 9%, 100% risk, so 100% over here. Non-scheduled bank 8.5 means non-scheduled and less than 9, so it is non-scheduled less than 9. See this 150%. Okay, so you come over here 150%. Now just apply these figures. See here, I won't repeat these figures now. You just see these figures 300, 200, 100 and over here also 5, 3, 2, 5, 50, 50. Okay, 5, 3 to 50, 50. Okay, we'll just solve this part. Okay, and remaining is easy. So let's solve this. See this 5, 3 to 50, 50 and apply those figures which I have told you. 20, 20, 50, 100, 250. Okay, got this point? Everyone total, you can total this now. Second part, same thing for this. So total is this 435. If you do this total, you will get this as 435. Done with this. Second part, for that loans, what did I tell you? Let it be loans, let it be call money, let it be anything. It's only type of bank and this CRAR. Okay, so same rule, 100, 100 and 150. So apply this 300, 200 and 100. So apply this, you will get a total again. So total is what? 650. For, see this, 300 plus 200, 500 plus this 150, 650. So earlier one was 435. This is 650. So what is the total RWA now? 435 for earlier one call and 650 for these loans. So 1085 is my total RWA. Now if I have got this RWA, what is the remaining now? Use the formula. CRAR equals to, I'll just write it over here. CRAR equals to capital upon RWA, right? RWA I am having it. Then capital, is there any capital? No. But what is asked? What is the question given? Question is of the capital only. See here, the question is for the capital. See here, what is the amount of capital fund? Okay, and tier 1 and tier 2 capital. So you have to find out capital. So if you have to find out capital, CRAR should be known to you. So CRAR you have to take it as 9% because it's RBI calculation. So use this now. 1085 capital is what? 9% into RWA. 1085 into 9%. So it is 97.65. This is my capital requirement total. Now out of this total, I have to do what have I to do? I have to bifurcate it between tier 1 and tier 2. Okay. So how to bifurcate? How to bifurcate between tier 1 and tier 2? See here. Always remember this thumb rule. Whenever you don't know what is the tier 1 given, what is the tier 2 given, take it 50-50. Because that will satisfy the rule that T2 cannot be greater than T1. Okay, that will satisfy this rule. Okay, so T2 48.825, 48.825, divide this by 2, you will get these two figures. So here this rule is satisfied. 48.25, 825 is not greater than this above figure also, it's equal. Equal is allowed. Okay, not more than that is not allowed. Okay, got this point? Yeah. Yeah, one more options problem I had to take here. That's what this was important part. Let me clarify, remove this. Okay, one sec. Options, one sec. Let me remove this, change this slide a bit. Okay, this is what you are getting a problem. Let me just give me 1 minute. Yeah, so that I can change, make this slide more clear to you, because this options problem is important and the concept should be known to you. Yeah. Yeah, now this part. See here, the one options problem comes to you in exam. Okay, so options problem means what? Here they'll give you some simple option. It's not a difficult option part. Always remember this. They'll always give you a simple option. 2-3 things you have to remember in options problem. Always, huh? What are the 2-3 things? Number one, how many are the players in the market? Players. Okay, players in this options market, number one. And number two, you have to remember the types of prices: market price, strike price, strike price and stop loss price. Okay, these three things you have to remember from CAIIB point of view. Always remember this. Okay, market price, strike price and stop loss price, and how many other players over here. Remember, in any options market there are three players, always three players only. One is market. Let me see if I am having the slide over here. Yeah, I am having some free slide over here, so I can write it over here. Okay, so remember, there are three players always in the in any options market. One is this market. Market means actual market. I'll write it over here, it becomes easy for you. See, this one is this market. Second is what, this you means who are the buyer. Buyer, sorry, buyer. This is the market, open market, and this is the seller. Seller of the options. Generally we call this as the insurance company. Okay, seller. Okay, so this is seller. So seller or writer also. The word is writer for any options market. It's a writer word. Okay, so there are only three players. Once you understand this concept of three players, then you'll understand this problem. See here, what is the problem? You make a contract with the insurance company, means what, seller. Okay, in, this contract seller or option seller. You make a contract with this insurance company that they will buy the stock at rupees 40 from you, if and when you wish to sell, when let's say in 3 months. Okay, so this is the point given over here. So now how many parties are there? You and the seller. You have a right to sell. See here, if and when you wish. If you don't wish, you won't sell. So you are a buyer. Remember, options buyer always has a right, but not a compulsion to buy or sell. Okay, once you have this options contract with you as a if you are a buyer, then you have a right. You can sell to this person or you can sell it to other person also. Okay, so point number one. Second, you pay a premium of $3 to him. No, you are paying a premium to this person. Why? See here, it's like that insurance of your bike or your car. Whenever you take the insurance, you pay the premium to that insurance company, right? And if nothing happens to your car or bike, what's the point? The point is your insurance premium is gone for that year, right? But if something happens, then you'll immediately run to that insurance company, isn't it? So that's the way. Call option is also similar to that of that insurance. If nothing happens, you don't exercise this call. You don't sell it to this sell it means exercise this contract and sell it to this person. He'll say, okay, nothing, no problem with me. $3 I've received it. So how does this seller earn? See here, you will earn. I'll tell you how the whole market will go over here. Okay. Now let's see one by one each case. See here, you, option seller and market. Three parties. Remember. You are, let's say, A, this seller is B and market is M. We'll consider this A, B and M now. Okay. Now understand one important part over here. Put and long and short position. Remember, in long position you buy this stock and with the thought that it will go high. So then you will sell it. See this, it's like this. You have bought this stock. Let's say the price of that stock is current price, market price. Okay, market price is 30. And this is your strike price. Means what your target is, that is your strike price. Okay, always remember, whatever is going on in the market is the market price. Whatever is what you have thought is the strike price. Okay, so market price and strike price, these two are important terms. Now what happens, say this, long position means what, you buy at 30 expecting it to go to at 40, means you will sell it over there. So this is known as long. Buy low over here and then sell high. But what is the short position? Short position is the reverse one. You sell first, means if the stock is presently, the market price is at 40 and you expect it to go to 30. Understand this. This is known as short selling. Okay, so you are at 40 and you expect it to go to 30. Market will fall. Then what will you do? You will sell first at 40 and when the market will go to 30, you will buy it. Isn't it simple logic? So buy, always, let it be long or short position, you always buy low and sell high. Okay, in short position you first sell high and then buy low, but after all buying is at low price only. Got his point? So move on. So now remember one important exam question. Whenever you have a long position, what is the option we should choose? That question comes in the exam. The option to choose is put, buy. Okay, always remember, whenever you are in the long position, buy the put. Whenever you are in the short position, buy the call. Remember this. Okay, move on. Now what happens? Let's say the price of that stock is, let's say 30 now. Okay, present price what is given? 30 over here. Okay, and let's say you have made a strike price of 40. Now what happens? Let's see the cases one by one. Now if the this market or price of that stock goes from 30 to 20, it is reduced. So what will happen? Now you are a, this is market, this is this buyer 40, where you have made a contract at 40. Okay, now the price is 30 at which you have bought, market price is 20. So what will you do? Will you go to market or will you go to this B? You will definitely go to B, because you are earning over there. Here you are losing 30 minus 20, 30 to 40, right? You are earning over here, you will go to this B. So whenever this market price goes down, you won't be at a loss, because you have made a contract with this guy. Okay, so at that time you will again earn how much, that I'll tell you. Okay, now second case, let's say here, okay, I'll tell you now only how much will you earn. See, this price falls to rupees 20. What happens in this exam? You will be asked a question, see this like this: if the stock price of this XYZ falls to 25, what will happen to that investor? Will he lose? Because logically what will everyone tell me? 30 was the buying price, 25 is the selling price, so he'll lose 5 rupees, but he won't lose anything. Why? Because he has made a contract at 40. Why will he go for this 25 if he is having some buyer at 40? So he'll go for this 40. And what will happen with this buyer? He sells it at 40. He has got rupees 40. Now 40 rupees is in. What is out? That stock price of 30 and this 3 rupees premium which he had paid, right? 3 rupees also he has paid this. So 33 is his total BEP, break-even point we'll call it. See here, break-even point means what? Where I don't have any profit or any loss. Got this point? Any profit, no loss, no profit, no loss. So that is BEP. So now if it is BEP, so what happens? 30 plus 3, 33. So any price beyond 33 is his profit. So what will this guy do? He has lost 33 and he has gained 40. So he'll gain 7 rupees over here. Now second case is, if the market price goes to 55 of this stock, he had bought it at 30. Now again A is at 30 over here, 30 over here, market is at 55, B is at 40. Will he go to B now? He'll say, okay, hell with your 3 rupees, gone money, I don't care for this money. Okay, 3 rupees, but what am I earning over here? 30 to 55, 25 rupees. So what is his loss? His loss is this 3 rupees. He'll say, okay, 22 rupees earned. So net profit of his is 20 rupees. Okay. Now remember one important part. What is the maximum? One question asked to you is this: what is the maximum gain to the investor? So maximum gain to the investor is what? It's unlimited. Why unlimited? See this, unlimited because this price can go from to 55, it can go to 100, it can go to 1000, anything. So if it goes to 1000, what happens? This price from 30 to 1000, he has earned 970, isn't it? And this 3 rupees gone, 967. Okay. So always remember, in options, buyer will have unlimited profit and limited loss. Okay. Now third part, if this price goes to 35, okay, so of this stock, what will you do? Again, bought it at 30, market is at 35, B is at 40. He'll definitely go to B, isn't it? He won't exercise it. So remember one basic rule: any market price below the strike price, okay, this guy will never sell it to the market. He'll sell it to the B party only. Okay. Now important part over here is this market price less than strike price. This part is what will be important for you from one liner's point of view. See this, whenever this call money, you are dealing in call. Okay, let's say if it's a call price, okay, call option. So if the market price is less than the strike price, okay, market price is less than the strike price, okay, then it is called as out of money. Out of money. Okay, remember this, market price is less than the strike price, it is out of money. Market price is greater than the strike price, it is called in the money. In the money. Okay, and market price equals to strike price, then it is called as at the money. ATM we call it, at the money. Okay. Now this is for call. For put, it's the reverse thing. Now I won't go for this put now because it's simple. Market price greater than strike price, then it is out of money. For put, okay, put, market price greater than strike price, it is out of money. Market price less than strike price, in the money. Okay, for put. Only remember it for call and just reverse the things for put. Okay, that's it. So now look at this case study. What will happen? These are the two questions I have taken. What is the maximum gain to the investor? Unlimited, because this price can go to anywhere. If the stock price drops to rupees 25, then the investor will exercise the put, or means what will happen? He won't go to this 25 market then. See this part. He won't go to this market, he'll go to this B. So he'll gain 7 rupees over here now. Okay. So this is one important part. Okay. Now one more case study which I want to take over here is this one. This international bank repricing assets. Yeah. This is the last case study for today. Okay. International bank has the following repricing assets and liabilities. Simple case study, but we always fall, the wicket is always falls on this one. Okay. Simple case study. Googly ball, it's always okay. Those who play cricket, they'll know googly ball. Okay. So now international bank has this. Firstly, are you understanding it? That's important. Type yes if you have understood it. Type yes, and also the likes. I am not seeing the likes over here. Likes, everyone. Okay, I am not seeing the likes over here. Click on the likes. Everyone should like this. Okay. Like the video. Buffering is important for you. Live buffering will only happen if the number of likes equals to number of views. Okay. Move on. Type yes if you have understood this. Fast type yes if you have understood this up till now. Because these are all 5 marks case studies and these will decide whether you pass or fail. Isn't it? Okay. So let's move on. International bank has the following repricing assets and liabilities. Okay. Call money is given as 300 crores. Forget, I won't read this CR now. Crores. Call money is 300. Cash credit is 240. Cash in hand is 200. Savings bank is 300. FD is 300. And current deposit is 250. Okay. So this is what, these are the figures given for the bank. Okay. Now firstly understand this. Call money, first you have to always define what is an asset, what is a liability. Okay. What is an asset, what is the liabilities. Remember, whenever you buy the call money, remember this, international bank has the following assets and liabilities. It has bought this call money. Call money, who sells it? Call money is always sold by the RBI. So for RBI it's a liability, for you it's a asset. So asset for any bank, call money for with any bank is a asset. Cash credit loan, it's a loan, asset. This cash in hand, it's a asset. Okay. Savings banks, liability. Fixed deposit, liability. Current account, liability. Okay. Now these are all 3 assets, 3 liabilities. Right? That Gabbar Singh, 3 आदमी 3 गोली. नहीं क्या? 2 आदमी 3 गोली. That was the logic, isn't it? So no, what? 3 आदमी 6 गोली. I have forgot that dialogue now. 3 आदमी 6 गोली. बहुत नाइंसाफी, isn't it? So that same logic. 3 asset, 3 liability, right? And both non-insafi. Move on. Okay. Chalo. So asset, cash credit. Now one important part about these assets we have to define. See here, they have given this figure as repricing. Repricing. What do you mean by this word repricing? Repricing means which changes with the change of interest. Changes with the change in interest means what? If RBI increases the repo rate, who will be affected? RBI increases CRR, who will be affected? Remember this. Okay. Call money will be affected if it increases the repo rate. See, repo rate and call money are always related. Cash credit loans will be affected because loans rate will definitely change if RBI changes the bank rate, repo rate, all these things. But cash in hand, will that change? Suppose if you are having, let's say 1 lakh rupees in your home, kept in a cupboard. Let anything happen to inflation, will that 1 lakh rupee change? No. So that is not a repricing asset. Cash in hand is not a repricing asset. Okay. Savings bank, it will change because it's after all the interest we have to give. FD, interest we have to give, so it will change. Current account, do you give any interest? 0. So it's again not a repricing asset. So what are the 2 non-repricing assets over here? Cash in hand 1 and second is this current account. Okay. Got this point, everyone? These 2, this is the only catch in this problem. Remaining thing is, this problem is the easiest one. Okay. Cash in hand is a non-repricing asset, current account is a non-repricing liability. Remaining are the repricing assets and liabilities. Okay. Let's move on then. Now the figures are simple: 300, 240, 200, 300, 300 and 250. Okay. Let's move on with the cases. What is the adjusted gap in the repricing assets and liabilities? Okay. What is the adjusted gap here? Adjusted gap. Gap means what? What do you mean by gap? Assets minus liabilities. Okay. What are the assets minus liabilities here? Always adjusted gap in the repricing assets. We want repricing only. So only saving FD, only call and CC, no cash in hand, no current. Okay. So 300 plus 300 minus this 300 plus 250 is 60. Okay. But what is this 60? Saving plus FD is 600. Okay. And his assets are 540. So what am I? I am on the negative side, right? My liabilities are more than my assets. So I am in the negative gap. Okay. Hence the negative gap. Remember, cash in hand and current account are not subject to repricing as they are not interest bearing activities. Okay. Done with that. So I am in the negative gap over here. Remember this. Now thumb rules for negative gap. Always remember. Okay. Have I given it? Yeah. These are the thumb rules. Always remember this thumb rule. If the gap is negative, okay, remember this. By heart this. Gap is negative. Interest rate falls. Understand this. Interest rate falls. NII or my profit increases. Gap negative. Interest rate falls. My NII increases, profit increases. Gap negative, interest rate increases. My NII decreases. Remember, profit decreases and vice versa. Okay. Gap positive, interest rate falls. My income decreases. Gap positive, interest rate increases. My income increases. Here, keep it very simple. Why remember all this table and everything? How much will you remember? You are not a computer. You are a human being. Okay. Always remember one basic rule. If liabilities are more and the interest rate falls, okay, your income will increase because you have to give lesser amount now, lesser interest, right? So income will increase. Money saved is money earned. You'll save on this money, isn't it? Similarly, by if assets are more and the interest rate falls, your income will decrease, isn't it? That's simple. So let's move on with this case. What is this? What is the change in the net interest income if the interest rate falls by 2% across the board for all the assets and liabilities? So if it falls by 2%, here gap is negative, interest rate has fallen. So gap is negative, interest rate has fallen. So my income will increase. So what should be the answer? Positive is the first part. But what positive figure? 60 crores is my negative gap into 2%. Okay, so 60 into 2% is upon 100, obviously. So 1.2 CR. So this is my increase. So again remember this. Negative gap, interest rate falls, income increases. Negative gap, interest rate increase, then my income decreases. Okay, got this point? Everyone understood this? Firstly type yes if you have understood this. Everyone type yes if you have understood it, because this is the easiest case study ever possible in BFM. But you need to understand it. Okay. Type yes, everyone. Okay. Got this point? Okay. Now we'll move on. Last question. If the interest rate on the assets and liabilities increases by 3%, what is the change in the net interest income? So interest rate increases. Again, negative gap, interest rate increase. See here, negative gap, interest rate increase. Negative gap, interest rate increase. Got this point? I am again stressing this point. Negative gap, interest rate increase. So my income will decrease. So what will be the answer over here? 60 crores is my gap, negative gap, and 3%. So 3% means 0.03. So it is 1.8 CR, but decline, right? Decline. Got this point? Everyone type yes. Okay. So before leaving the session, I would again suggest go for this batch if you are not able to clear tomorrow's exam. But here, always remember, I always see many of the students getting very much dejected that no, nothing will happen in life now. BFM gone. Again, there is nothing. Life is huge. Remember, life is more than this CAIIB, more than this banking. Life is bigger one. Never focus. See here, always remember one basic rule, because I have seen many students feeling so much dejected after failing in this CAIIB, ABM or BFM or anything. So much. Never do that. Okay, this is just one part of your life. There is always one train goes. Do you wait, stay on the station only? other train definitely comes. So life moves on, and always that's what I am saying. If you, somebody of you may not be able to clear it, then don't feel lost. Join this batch immediately from July, for next day, Monday. Okay, immediately join it and start with a new vigor. Okay, and you will definitely clear it. Okay, but I would again tell you, best of luck and clear this exam as fast as, be one, two, three thumb rules I'll give you. Okay, first thumb rule number one: be very cool in this exam. Remember, only 2 to 3 thumb rules. Okay, be very cool in this exam. Never haste. Never haste. Yes, I know this. Yes, I know that. No, I don't know this. Forget everything. Be calm. Take a deep breath. Okay, and then start. Number one. Number two: if some problem is very difficult, you are not able to solve it, don't waste your time. Don't waste your time. Move on to the next problem, next theory problem, whatever it is. Okay, point number two. Point number three: always try to solve the case studies first. Always try to solve the case studies first. Never focus on one liners. If the one liners are easy to go, only solve them. Otherwise, leave the one liners, focus on case studies, because 12 case studies roughly of 5 marks each, 12 5 is 60. Passing and failing will depend on these case studies only. Will depend on these case studies. Remaining everything is just a flavor. It's like that cake, right? Ice cream, right? Ice cream, basic ice cream is vanilla. Everything is a flavor. So basic ice cream is this. What? This case studies. Okay. Remaining all these 40 marks of flavor. So 3 thumb rules. What I have told you. Be cool. Second, if you can't solve any problem, leave it. Move to the next problem. You will get some hint in the paper somewhere for that problem which you have left. And third, focus on case studies. Okay, so bye from my side. Best of luck to you all. Okay, and see you with the flying colors tomorrow. Okay, okay.